lecture 7, so I'm going to be talking about market making, just sort of giving a brief introduction as to how it works, why it works. And then Hilliam over here, who is our guest speaker, will be sort of discussing it in a bit more of the context of decentralized finance and so on and so forth. This is our structure so far. So we're now on number 3. Next week, we've got Black Skulls coming in regarding risk management. Is it next week or week after, rather? And then there'll be on-chain options, which we discussed about last week, and some macroeconomics with Ledger Digital, which is a subsidiary of Nomura. So let's think about if we're sort of looking for people that want to buy and sell things. Let's look for an Ether, for example, which is a type of cryptocurrency, as I'm sure most of you are aware of. Start looking for orders. So some people want to buy, some people want to sell. So at the bottom over here, we've got an order for £1,357 to buy an Ether coin. It's all approximated, of course. What we can then do, other people might come into the market and then raise the buying price a bit, so on and so forth, until we have a canvas of different buyers who want to buy an Ether coin. Conversely, we also would have sellers on the other side from different locations around the world, hence decentralized in the context of crypto. They're all from different places around the world. And then we fill all these sell orders as well. So we have buy orders and we have sell orders. Essentially what happens is what we then do is we put it into a list and we arrange it from the lowest number on the bottom and the highest number at the top. We plot this using a numerical axis. We start at, say, 1350 on the bottom and 1380 on the top. And as some of you are aware, there's an Amazon code on the bottom right, so please claim that at your own disposal. So we start by putting some numbers onto the axis. This is all mathematically proportional. So 1357, then 1358, 1359, 1360, so all in British pounds sterling. We can then also fill the sell orders. You can see the color coding is according to the buy or sell labels that I've applied. We then call the buy orders, so people that want to buy an Ether coin, we call them the bids because they're bidding for the coin. And then I'll say that the people who are selling the coin are what we call the ask prices because they're asking for somebody to pay them. A little gap in the middle here, so the highest bid price and the lowest ask price. This is what you otherwise known as a bid-ask spread. The reason why it's called a spread is because a spread denotes a sort of difference between two different points. Some of you will have studied A-level maths, interquartile range. It's actually also known as interquartile spread because how dispersed the data is. So how far apart the highest bid is from the lowest ask is otherwise known as the bid-ask spread. The tighter the bid-ask spread implies that we have prices that are much closer to the middle. And if they're much further apart, then obviously, then what it means is that we have fewer buyers and sellers that can agree or close to an amenable average price. So here, doing the simple maths, it's around 14 British pounds. What we can also do is not just plot the prices of the bids and the asks. What we can also do is we can actually plot a histogram of the quantity of people that want to buy and sell at each price level, or rather the amount of coins that wish to be traded at each price level. So what you can see actually over here, if I point out my laser, put up, I'm not sure if I use this cursor rather, this, rather not. Anyway, so what you can see is that in the extremities further away from the middle, so between 1360 and 1374 is where the middle lies, as you go further away from the middle, there are many more people that want to sell and buy respectively. And that does make sense because buyers want to buy at the lowest possible price. So you're going to find more people, more volume at the bottom, further down, the buy orders, and also more people further up because they want to sell at a high price. So around the middle over here is where you get the lowest amount of volume, lowest amount of buyers and sellers. So how will we then determine the prices of these sorts of markets? I've introduced to you the idea of bid-ask spreads and so on and so forth. Well, the market is essentially just a place where people can buy and sell stuff. It brings buyers and sellers together. If we're looking at crypto, quantitative trading, which is what we're here for, we're using something called decentralized exchanges. When we are at an exchange, as you saw in the diagram previously, buyers want to buy, sellers want to sell. It's just like an auction. In fact, it's very identical. And then we can arrange the orders in terms of how many people want to buy or sell a coin or the number of people available into a histogram. We've already arranged it by the price level. And this histogram, essentially the price levels and how many people want to buy or sell, is what we call the order book. And I've mentioned when we look at a buy order, people that want to buy, we refer to them as bids, and people that want to sell, we refer to them as an offer. And the number of units that are mentioned in the order, so how many units that want to be traded at a specific price, is known as the volume, normally proportional to the number of people there are at that price level. So I'm just making that diagram a bit clearer. Again, another Amazon code for your entertainment. How do we then determine the market price? Well, there are two ways that you might see. Sometimes you'll see the market price being put right in the middle of the highest bid and the lowest ask. In this case, as I mentioned, 3067, in the middle of the bid-ask spread. This isn't always the case. Some of you who might have been on exchanges, or I use different types of exchanges, sometimes it's quoted as the last price of the trade. So just be aware of what you're being quoted as the market price. It can be the last price at which a trade happened. So, for example, a trade might have happened around 1360 if somebody from the ask from the sellers was agreeing to move down in terms of their selling price. But sometimes it can also just be quoted as the middle, just for as a metric to show where the market lies. Just a couple of other things before we quickly brush onto Hilliam. This is the last slide. In terms of actually looking at the bids and the asks that come into the order book, that's what we call order flow. So we look at how many bids, how many asks are coming in, and the volume, and sort of essentially where they're at. Now, sometimes investors would not care about putting a bid or an ask. They just want to buy at the market price, or the first available price that they have. That's otherwise known as a market order. Conversely, you might find some investors might wish to put their price at a specific level in mind, and that's called a limit order, because essentially they're putting a limit on, so when the prices hit that limit, they want to buy or they want to sell. No higher or no lower, depending on the circumstances. Stop loss order is the sort of the inverse of that. So if you have a stop loss order, it means that you want to sell your asset, in this case an Ether coin, if the price of your coin has fallen too low. So, for example, it's literally actually to stop losses. So, for example, if your Ether coin is trading at 1350 and you want to sell the moment it falls below 1,200, you sort of program your strategy to say that if it goes past 1,200, execute the stop loss order and just sell my coins, so I don't lose any more money. A trading stop is slightly more complicated. Basically you attach a percentage to the market price, and then you sell the asset at that specified boundary. So if you're at, for example, $100 and you have a 10% trading stop, 10% of 100 is obviously 10. So you sell the coin at 10% below the market price, which is $90. And as always, if you're ever going to be able to code up your quantitative strategy, always backtest. So use historical data to see if it works before you actually execute them in real life, because you never know what might be around the corner. So with that in mind, I'm going to introduce Hilliam over here, who's from GSR, and he's going to talk a bit more about, well, what we've just spoken about, but in much better depth than I could have ever done in the context of decentralized finance. So if you could all please give him a round of applause, and we'll get going.
Nice. Okay. Can you guys hear me now? Okay, good. Yes. I'm just getting my notes and whatnot. There we go. Christ, I have to say, like, yeah, I was like a previous GMC graduate, in fact, literally just graduated just this year. But yeah, being in Claw really brings back memories. Like, yeah, especially I remember like one of our maths lecturers would always like just play around with these different microphones. And there needs to be the small kind. So it's quite crazy to see that it's sort of now modified. It's like this hunk of metal. And plus, you know, it's not small where you can easily lose it or someone might nick it. Yeah, anywho. Yeah, so I'm Hilliam. I'm a recent GMC graduate. And yeah, basically work with GSR. Yeah, pretty much it's a case in which, yeah, with GSR, we're one of the largest crypto market makers out there. So as Ahmed was saying, that pretty much market making involves putting up different limit orders, whether that be buying and selling, whether that be specifically buying assets at a certain price before then after selling it at another price later on. pretty much we're involved in all of that. Whenever you're interacting with a certain exchange, whether that be buying some Bitcoin, just because you think that it will go up, we're on the other side of that as your counterparty. And so pretty much we're pretty much always there in the markets trading and pretty much providing liquidity in the sense of we're providing limit orders, we're providing these different prices that you can buy assets at, where you can always buy these assets from, us 24/7. So yeah, that's pretty much our job. So that's pretty much what we do. For me specifically, I work mostly on DeFi as well as MEVs. So DeFi is like a really, really growing thing, especially when it comes to crypto. You can of course trade crypto as another traditional asset on a centralized exchange, such as your Binances, your Revoluts, your plus 500s. But I think the really, really cool things that you can do with crypto really comes on chain in the form of decentralized finance. Let's see. Pretty much. So I have recent graduates. Have worked on a bunch of trading systems. Most of this case in which over this next 45 minutes, I'll be going over a couple of different things to do with the blockchain, just to sort of bring you at ease to how different it is to traditional exchanges. And also talk about on-chain order books, or what we like to call central limit order books. So pretty much how you have your traditional exchange order books, this would be your on-chain variants of that. Also speak about limit orders and how we can effectively emulate them on-chain using automated market makers, such as you might have heard of Uniswap or SushiSwap or PancakeSwap. And so we'll be dipping into that. And we'll also be looking into traditional strategies, so traditional quantitative strategies to do with decentralized lending protocols. So decentralized lending protocols being a on-chain variant of money markets in which you can potentially get loans from different people to then afterwards trade and essentially leverage up your position. And then finally, I'll be speaking about like some of the really, really cool things when it comes to the blockchain in terms of atomicity, so being able to have atomic transactions that you can execute all the trades in, so that you pretty much execute all the trades, bam, 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 and essentially profit from that with minimal risks. I was speaking about flash loans and dip a bit into MEV and the cool stuff about that. Just a show of hands to sort of understand where you guys are sort of at. I guess how many of you guys have traded crypto previously? Very nice. And then how many of you guys have touched a crypto wallet or have interacted with DeFi in any context? Nice. And then who actively trades NFTs, cryptos, and whatnot? Not bad, not bad. I mean, luckily it's the case in which I'll be going through and just essentially giving like a really, really good introduction to it all. And so, for anyone new, hopefully it's the case in which, it won't go over too much of your head, but if not dead, you can, there will be time in order to ask me questions at the end. Okay, let's see. Okay, cool. So, as I mentioned earlier, when it comes to traditional exchanges, so your Binances, your Krakens, your London stock exchanges, pretty much all of these different traditional exchange systems rely on this sort of ordering system, which we often like to call sequential order execution. So whenever you would like to, let's say, buy some Bitcoin, sell some Ethereum, place a limit order on, let's say, on the Uniswap token, and hopefully someone else buys in the future. Whenever you're submitting those orders through one of these types of different exchanges, so London Stock Exchange, Binance, another good example might be Crypto.com app or whatnot. These sorts of exchanges, as I said, follow a sequential order execution. What that means is pretty much once you submit the order, so once you submit the order, anyone else that submits the order after you pretty much gets executed, pretty much gets their order processed after you. And so pretty much as the name suggests, sequential in the sense that you need to get your trade into the exchange first to have your order processed first before other people can essentially get their orders in if you'd like to be first ahead of others. And so when it comes to that, lots of trading firms are very, very key in terms of optimizing their speed when it comes to that. So pretty much where market makers like us are pretty much spamming thousands of different orders out every single second. And when you think about how different competitors like Wintermute, Jump Crypto and whatnot, they're also like spitting out so many different orders and limit orders and market orders out there in the market. That's pretty much how the exchange, so how Binance would actually order those would be based on the time that they essentially get the order at. And so that's where the sequential order execution comes from. Whether it's first when it comes to the order processing, whoever's order reaches the exchange first, pretty much gets executed first. And so pretty much we're pretty much playing very much a low latency, high performance speed game when it comes to that. And so, yeah, very similar to like how other traditional firms work, like the BlackRocks, your Citadels, your Citibanks and whatnot. And so very much is a case in which luckily a lot of traditional knowledge comes over when it comes to that. If you're ever interested in like any stuff like in understanding traditional systems, I'd highly recommend this book that I've listed. It's a nice laser. I definitely would suggest this book down here in terms of, especially if, let's say, you're a computing grad wanting to get into the software engineering side of trading and really understand how a trading system works. Let's see. Okay, cool. So yeah, so pretty much think about it as your traditional exchanges work on the sequential order execution, get your trades in so you can be first. Now, when it comes to blockchain, it sort of works very, very differently. So pretty much as the name suggests, first of all, the blockchain, how it does things is that it processes transactions, these different orders in batches that are called blocks, hence the name of blockchain. And so it basically processes these orders in blocks in batches that we call blocks. Very much is a case in which the window of time that you get in order to submit your order for it to be then put in the next block is what we call a block time. For, let's say, blockchains like Ethereum, it's roughly 12 seconds. For, let's say, the Bitcoin network, it can be roughly 1 hour, just because of how long the blocks take. And so very much is a case in which once a block is processed, a number of different transactions within inside of that block, a number of different orders inside that block are also processed as a result of that. Now, pretty much, so pretty much where these sorts of transactions, where all these different orders and transactions land inside of the block, that's actually determined by not exactly sequential order execution with traditional exchanges, but more so by a different mechanism that we like to call the priority gas auction. So very much here, it's a case in which whenever you put in your order, so let's say I'd like to buy some wrapped ETH for this amount. I'd like to, let's say, sell Uniswap token for this other amount. When you're interacting with a decentralized exchange, you also have to put alongside a bribe next to it, which we like to call gas. So pretty much it's quite sophisticated compared to your traditional systems, in which you also have to think about the transaction fee that gets attached with your order. So pretty much gas bribe, ether is you often might hear to be a transaction fee that that is associated with your transaction on the blockchain. Here, pretty much it's the same mechanism in the sense that, pretty much we have to worry about a transaction fee when it comes to actually executing your order. Now, when it comes to thinking about all these different transactions that you might receive in, let's say, 12 seconds, imagining you were the Ethereum blockchain, so you get like a ton of different transactions coming into you, let's say thousands, hundreds get processed every single block. And pretty much how the Ethereum blockchain works in terms of how it sort of orders those transactions is actually by the bribe as attached with those transactions. So very much is the case in which whoever pays the most, as long as they get the transaction in within inside those 12 seconds, whoever pays the most comes out first of the block. Whoever pays, let's say, third most, comes out third. And so it's another ball game when it comes to thinking about how you would sort of make your strategies and sort of how you make your strategies in terms of thinking about where you'd like your orders to be placed. Now, what can happen is, let's say, with this 12-second window, you can place your order in at, let's say, a bribe of 0.1 ETH. And let's say, and because of the fact that this group of pending transactions is public, what someone can do is look at your order, place that, look at your order trying to buy, let's say, the Uniswap token for a specific amount, and you've attached a bribe of 0.1 ETH in order to have your order processed as soon as possible. What someone can do is, if they really, let's say, really want to buy a Uniswap token as well, because there's a governance event in which it makes it more, in which it raises the price, then what someone can do is give in a higher bribe. So let's say 0.11 ETH, and essentially front run me. So that is one of the interesting consequences of this sort of system, in which essentially someone can jump ahead just because they paid a higher bribe than you. Now, what someone else can do also is they can also backrun me by matching essentially the bribe that I'm paying, and then afterwards just executing it execute it after mine. And so very much is the case in which a lot of your transactions on chain might see a lot of these different actors working seamlessly behind the scenes, trying to front run or back on your transactions, let's say. Someone might be, let's say, if you're, let's say, minting an NFT, someone might try to jump ahead of you in order to mint, let's say, NFT 1000. And so, you unfortunately get NFT 1001, which might be worth less than, a special NFT 1000. And similarly, there's interesting things that can come about people backrunning you, especially when it comes to thinking about, let's say, orders that you've made and potentially taking the arbitrage from your market order. Let's see. Before I'd like to jump into the whole meat of everything and whatnot, I think I'd like to just bring up some terminology that I often use. Pretty much cryptocurrencies, tokens, assets are very much something that I use synonymously, in the sense that cryptocurrencies are just digital tokens, assets on the blockchain. And very much is the case in which I'll be thinking about them more so hosted on a specific blockchain. So you might hear about specific cryptocurrencies such as Cardano, or let's say a Chainlink or whatnot. Some of these cryptocurrencies operate on their own blockchain. But in order to just make things quite easy to think about, you can just think about all of these different, all of these different cryptocurrencies operating all on the same blockchain, on the Ethereum blockchain. That's where a lot of these, that's where a lot of DeFi protocols are at the minute, and pretty much is the case in which that's where you can think of as all of the activity being on chain currently. And so, yeah, I'll refer to like a couple of like these during like the sessions, such as Ether, Uniswaps, and Circle stablecoin. Let's see. So yeah, also I think you might have picked up as well that I use transaction and orders synonymously as well. That being that more so a market order, let's say a order to buy at the market price, let's say 1 Bitcoin, is pretty much a sort of action, it's sort of classed as an action that you do on the blockchain. And pretty much, we just call them transactions more so, since in a sense, it's sort of like a interaction that you're making, a financial interaction that you're making when it comes to buying these different assets. And so, I'll speak later. And so pretty much you can think of a transaction as doing some type of action, either whether that be a market order, making a limit order, canceling a limit order, or let's say liquidating a perpetual position, or exercising an option, let's say. And I also use the term smart contract protocol, pretty much code that executes on the blockchain. That's pretty much what a smart contract or protocol is. So you don't need to really overcomplicate it too much in this session. Pretty much you can just think of it as some software that runs on the blockchain and benefits from it being on the blockchain, which we'll speak about later. Yeah, so Ahmed mentioned earlier, pretty much exchanges are one of the most prominent ways in order to interact with finance, and especially decentralized finance. And more so, we'll be speaking about decentralized exchanges. So as I mentioned earlier, it's the case in which central limit order books are things that you have already off-chain, in the form of, let's say, these different central limit order books, such as Binance or Revolut, that happens in the back end. Plus 500 is a good example. London Stock Exchange and their order book is like quite immense. There's like so many different players involved and sort of making these limit orders, trying to buy, sell these different assets to you. Pretty much is the same concept over when it comes to thinking about on-chain. Just that now we have the code of the exchange hosted on the blockchain, and very much is the case in which we have all these different actors on the blockchain trying to essentially put in their orders and buy some assets and whatnot.
How is the market making landscape on certain change since Alameda blew up, and does GSR market making too?
I'll answer that afterwards. Pretty much it's the case in which all these like different players and whatnot. Now that these order books are now hosted on the blockchain, pretty much it's the case in which there's many different players trying to, let's say, buy and sell different assets on this specific central order book, and we call them a central limit order book because it's simply just a order book of limit orders, hence the name central limit order book. And often you see this abbreviated as CLOB or clubs or whatnot. And so there are some good examples of different clubs out there. So DYDX is a good example for, let's say, options trading. Ether Delta is another one in which that's one of the original clubs that existed on the blockchain. And pretty much, those are different examples and whatnot. But I think the key takeaway from this is the fact that now that it's on the blockchain, you still have to play by the rules of the blockchain. In which, thinking about that order execution system that we mentioned earlier. So this one, the prior to gas auction system, we pretty much have to think about not just how you place not just the price that you place your limit order with, but also a transaction fee, a bribe that you have to attach your order in order to denote where you'd like your order to be, when you'd like your order to be placed or processed, I would say. So would you like it to be processed at the top of the block? Would you like to be processed potentially 7th out of like the list of other pending orders and whatnot? So that is something that adds a bit of complexity that you might need to think about, especially when it comes to trading on the blockchain. Now, another consequence of this is the fact that since there is a transaction fee that users always have to pay when it comes to making a transaction, whether that be canceling a limit order, making a market order, let's say trying to liquidate someone, and very much it's a case in which there's always a transaction fee involved. And because of that, for traditional market makers like us, or for anyone who really just wants to place a limit order on a central on-chain central limit order book, there's a case in which that unfortunately is quite costly for market makers in order to make. So you can't be spitting out tens of thousands of limit orders if it's the case in which no one will take them, and it's the case in which no one will take them, and it's just not profitable. And so very much that has sort of introduced a lot of different innovations when it has introduced a lot of innovations that has come into market, especially with the introduction of automated market makers, which sort of do our job for us. So automated market makers is, you can pretty much name it all, in the sense that it's an automated market maker. So a market maker like us, GSR, makes buy and sell limit orders. Automated here means that it just automates the process for you. You can almost think of this as let's say you might have heard of those different trading bots out there that would often trade for you. You can very much think of it like that, but it's the case in which the algorithm working behind this is often quite static. So in order to, so generally it's a case in which when it comes to most automated market makers on chain, they sort of follow a sort of static pricing function, which tells this automated program, what do I buy and sell my inventory at? What do I buy and sell my tokens at? And pretty much from that, it gives you a deterministic price in order to essentially trade with. So you can go to an automated market maker and effectively say, what's the price that you're going to give me if I buy, let's say, 10 Ether from you, unlike the price in USD. Pretty much the automated market maker will determine the price based on this sort of pricing function. And this sort of pricing function is a function of its current inventory, so how many tokens it has, some fees it might associate with trading, like what sort of commission that I would like to make, as well as any sort of other factors that you might try to involve. Pretty much you can see here that, we often call this a price function, but we also like to call this a price curve as well. You can see here that very much is the case in which a lot of protocols have considered a lot of markets as considering just two assets. So let's say ETH and USDC. And very much what they would do is then essentially take those two assets and essentially trade between those for you. So you tell it to say, so essentially has a pool of ETH, a pool of USDC, and it will try to essentially trade with those because you need ETH to sell and you need USDC in order to buy some Ether as well. So pretty much is a case in which it needs to try to balance the two. And that's where this pricing function comes in. It will try to find some optimal way of trying to manage its inventory while still making money. While still making money, making these different buys, offering these different prices for different customers that come and essentially trying to buy or sell inventory to you. So pretty much one of the most prominent market makers is Uniswap. It's one of the oldest, in fact, and very much they work off this sort of function of a constant product pricing function. So very much is the case in which what it will say is that let's take two assets, ETH and USDC. Now it considers its reserves of ETH and USDC, and what it would do is just make it constant after that. And very much what it would do then is try to calculate a price from that where it keeps the constant. So I think this slide might, let's see. Yeah, so I guess this, yeah. So I guess, actually this slide might be good. So yeah, very much is the case in which you can see here is that we have so on, looking at the middle graph, it's a case in which, we have one axis, same quantity of asset B. So let's take ETH, let's say, and quantity of asset A, let's take USDC in this case. And very much what we try to do is that we use this curve in order to determine a price for us based on how much the user would like to buy. So pretty much, let's say with our current inventory, we're at this part of the curve right now that creates this constant curve for us and at this value of K. Now, let's say a user would like to buy a certain amount of Ether from us. Now, how we would determine the price from that is by essentially calculating the gradient from 2 points from that. So we would take like this point of the curve and pretty much essentially ask the user, how much would you like to buy? And essentially, just slip down the curve, essentially. Now you would slip down the curve and afterwards just draw a line across, determining how much is the change in the reserves that you would essentially sell for. And so that would then determine the price. The gradient from that is luckily just the price that you would give the user. And so very much is a case in which that helps us in order to, and so pretty much the shape of the curve allows us in order to be able to moderate how much end user buys, because of the fact that when you take the gradient at different points of this curve, because of the fact that it's inversely proportional, it's a case in which users who try to buy more of a certain quantity will have a higher price per unit. Now, on the left here is pretty much a constant sum market maker. A constant sum market maker in which it sort of tries to follow the same concept as Uniswap's constant product market maker, in which it tries to follow some invariant rule in order to then determine the price of its assets. So you can see here is that, pretty much it's this straight line that you see here. And pretty much, of course, the gradient is this, in this case, is always going to be this constant. And so very much you can see here is that the price in this case, because of the fact that the gradient is always constant, that is going to be the set price. And more so, it's often used for selling, let's say, pegged assets, certain assets that you might want to sell at a certain price. Would that be, let's say, I only want to sell Ether at 4,000 USDC and nothing more, nothing less. This allows us in order to sell different assets at like a set price, but more so is the case in which it's very rare that it's really used, just because of the fact that let's say the price might because of the fact that let's say the price isn't 1,000 USDC, what someone could do is either just sell a bunch of Ether to just dump a lot of Ether onto us and essentially get us to one side of this curve. Even though we're buying and selling at the set price, or someone might essentially buy up all of our ether from us if it's too cheap that we're selling at. And more so, then it's the case in which we lost out on potential profit. And so when it comes to this, this sort of a constant function market maker isn't really too helpful. But more so it's a case in which on the right hand here you see, is very much a case in which we have a mix between the two. So this is called a curve's stable swap pricing function, in which it sort of is a mix between the two. You can see here in the formula that it has some aspects of the constant sum market maker pricing function, but it also has some aspects of a constant product price function that derives from Uniswap as well. And so you can see here is that this blue line here dictates the stable swap invariant curve. And more so, it's a bit more flatter while still having these tailwinds at the very end. And more so is the case in which this curve really is quite helpful in terms of, let's say, if users would like to swap between two different types of USD stablecoins, be it USDC and USDT, which is a Tether's USD stablecoin, whether that be, let's say, Fluidity's stablecoin FUSD. This sort of curve allows users in order to keep a peg roughly around, let's say, 0.97 to 1.03 USD, or roughly about that exchange ratio. And so very much is the case in which we do see a lot of usages for the curve stable swap function, but also the curve protocol as a result of that as well. So very much like one of the cool adaptations of the Uniswap curve is this new iteration of it, which is the Uniswap V3 automated market maker. So pretty much one of the cool innovations about it is the fact that you can actually concentrate your liquidity. So pretty much when it comes to like market makers, we want to often be selling at specific ranges. Let's say, we don't want to be trying to like offer buy and sell limit orders at all sorts of prices and whatnot. We only want to focus on, let's say we only want to focus on, let's say buying and selling some ether between $1,000 to $1,200. But outside of that range, it's too volatile, or that it's not worth our buck trying to spend our resources. Then what we can do is that we can actually concentrate our liquidity, or focus more so on just providing limit orders within a specific range. And this automated market maker allows for us in order to be able to do that. So very much is a case in which, so very much as a result of that, as a result of sort of applying or sort of concentrating your liquidity in between this range, is the case in which you're able to, let's say, trade, you're able to set up buy and sell limit orders between $250 to $12,000. And that only requires just one transaction in order to do. Now, when it comes to thinking about, more so when it comes to like thinking about being a trader on that, so in terms of providing, being a market maker, or essentially trading the Uniswap V3 AMM, what you can often think about is the fact that a lot of these different when it comes to thinking about Uniswap V3, one of the cool things about the fact that you can concentrate your liquidity is the fact that it sort of replicates a lot of some of the instruments that we see in traditional finance. So very much is the case in which when it comes to thinking about, let's say, putting let's say concentrating some liquidity in a specific price range, is a case in which it very much is very similar to just a simple limit order on a traditional order book. And very much is the case in which we do see that being quite helpful, in a sense that because of the fact that we have this automation side to the automated market maker that buys and sells assets for us at specific prices, we're able to use it in order to be able to emulate certain positions. Very much you can see here is that if we, let's say, concentrate it at a certain strike price K, or a certain price K, it very much is a case in which it very much has a similar payoff to that of a covered call option. So very much is a case in which there's a lot of like cool things that can come out of essentially just trading on Uniswap, but also providing liquidity on Uniswap, and also allowing it to do these like sort of funky things for your tokens if you'd like to buy and sell different tokens. Yeah, so I've listed like some resources here and there if you ever like would like to like give it like some further reading and whatnot. Let's see. So yeah. Before that, any questions before I get on to the next section? Let's see.
Yeah, I was going to say my question about Alameda. What's the market making it like in Zero these days?
Yeah. So pretty much is the case in which so Alameda, if you guys don't know. So Alameda is a competitor, well, was a competitor of ours. Pretty much is the case in which what they do is that they, pretty much, as I mentioned earlier, place these different buy and sell limit orders on exchanges. And very much is the case in which they also did this on chain too, very similar to us. Now, when it comes to like the fact that the whole FTX situation happened, and very much that they've stopped business overall, Alameda and FTX as a result just essentially withdrew all liquidity, and also a lot of like liquidity essentially just evaporated on chain, but off chain, but also on chain as well. And so as a result of that, let's say a market maker goes bust. Because of that, the market is less competitive, and so you see looser spreads in the market. Is the case in which you might see that to buy, let's say, Bitcoin compared to sell it, that there's maybe like a $1,000 difference. Quite extreme, but it can happen. In the sense that if there aren't people competing to give you the best prices for when they're trying to sell you or sell you Bitcoin, then that's something that can happen as a result. And so very much when Alameda, FTX and Alameda blew up, essentially it was a case in which we had full reign really alongside Jump Crypto and Wintermute in order to just dominate the markets. So pretty much next section will be on just money markets and whatnot. Very much is a case in which it's very simple. When it comes to this, most of money markets, lending protocols, or just fancy words for essentially banking, or just even banking. Banking is like a funny word, fancy word as well, just for simply just lending. So very much is a case in which lending, pretty much is a case in which lending is just of course the action, of course just simply giving some money, lending it to people, and afterwards also being able to borrow money from people as well. And so people traditionally use a lot of lending and borrowing in order to leverage up and sort of have some capital that they can use in order to expend and be able to put it towards, let's say, specific assets that they would like to buy, have more exposure to specific instruments, buy more Bitcoin or buy more Ethereum, let's say, and then afterwards be able to see maximum rewards from that, whilst being able to, as long as they manage their risk, then they'll be fine. And so that's one of the main reasons why it looks like people. That's one of the main reasons why a lot of DeFi is very much circulated around decentralized lending protocols. So very much when it comes to lending, you can sort of think about it as two different categories. You have under-collateralized lending. So that's pretty much, think of it as you give $25,000, let's say, to someone, and pretty much you have nothing to be able to essentially take from them. You just hope, just God forbid, that they give you back the $20,000 plus $25,000 plus a bit more. Otherwise, it's a case in which you're in the shitter. When it comes to over-collateralized lending, that's a bit more protected, luckily, in the sense that if you might want to, let's say your bank, what you can do is essentially give out this $25,000. But what you might do is, let's say, you might hold some collateral from the user where it's worth more than $25,000. So that if the user doesn't pay back the loan in, let's say, a month's time, what you can do is you can go ahead and sell that collateral and get back your money. And so you're protected in that sense. And so very much when it comes to thinking about on-chain, a lot of, pretty much very much almost all protocols work on over-collateralized lending. And so that's what we'll mostly be looking at. You might have heard of the big names such as Aave, Compound, or Euler, in which they pretty much have money markets as large as probably going to the billions now. So as I mentioned earlier, it's a case in which a lot of different money markets that happen on chain are very much over collateralized. So what does this mean? So pretty much it's a case in which what you have to do is you have to put up some collateral first. So let's say put up $1,000 worth of Ether to then be able to borrow, let's say $800 worth of Uniswap tokens. And so pretty much why you might do that is, of course, to get exposure to Uniswap tokens. But what some people like to do, especially when it comes to these different lending protocols, is just simply if they have some Ether to spare, and they're not thinking of spending it, what they might do is put it inside of a lending protocol, and the lending protocol essentially lends it out to people automatically. Based on this, it's the case in which some sort of interest rate comes out of that, in which depending on the interest rate that they charge borrowers for, let's say, borrowing Ether, you might get your interest rate back in Ether, and that is a function based on how much the borrowers pay as part of the interest. So very much is a case in which when it comes to so pretty much how this sort of system keeps itself healthy, especially when it comes to thinking about making sure that all these different lenders putting in their money into lending protocols. How this sort of system keeps itself healthy and makes sure that lenders are protected is actually through this over-collateralization method that I mentioned earlier. And very much what happens is the fact that people can borrow loans against their collateral, but very much is the case in which when that happens, people can only borrow less than what they put into the protocol, what they lend to the protocol. And so that sets up a over-collateralized lend-borrow position. Very much is a case in which, let's say you put in 1,000 USDC worth of, you put in, let's say, $1,000 worth of Ether, and you borrow 800 USD worth of Uniswap tokens, let's say. Now, very much in that state. So I put in $1,000 and I borrowed $800 worth of Uniswap. Now, pretty much in that position is a case in which that's a healthy over-collateralized position. But let's say that the price of my Ether drops from $1,000 to now $900. You can see that that is starting to get risky, and if it drops even more to, let's say, $800 or even $700, then my loan now becomes under-collateralized. And that means that it's not possible to pay back the original loan. And so very much the lending protocol is always there in order to keep track of these positions and tries to make sure that that doesn't happen. How that sort of does it and how it sort of keeps track of those positions and how it tries to avoid that sort of a very bad situation where you as a lender don't get your money back is that what it would do is that it will set a certain threshold just above, let's say, 800 USD, let's say, in my current situation in the context. Let's say 850 USD is a case in which the price of Ether falls from 1,000 USD to 850 USD. Then my collateral can be liquidated in that sense. And what happens is that the protocol will liquidate your assets, 850 USD, essentially sell it off for Uniswap tokens, and it will give the lender back the original 800, whilst keeping 50 for themselves as a buffer. And so you can see here is that it very much emulates a traditional repo or repurchase agreement. If you guys have heard of that sort of terminology in traditional finance. So now, yeah, in terms of how exciting like this can sort of be is the fact that it also replicates, say, a perpetual option, and very much is a case in which there's a lot of strategies that can come after that. You as a lender, let's say you have some extra ETH in your wallet, you might want to lend some Ether to the protocol, and what you can do is now that you know that you're sort of protected in the lending protocol, you can still keep your exposure to that token whilst also being able to earn an additional interest rate, earn an additional income from that. And so pretty much that's something that someone might do. Another thing is the fact that they can borrow against their collateral. And so that means that they can now get into, let's say, riskier markets. So let's say if they would like to invest in like a certain token or at least have some exposure, then they'll be able to do that quite easily without having to sell their collateral. And so very much is a case in which a funding rate is quite an interesting thing to think about, especially when it comes to balancing these positions. And more so, like the two main things to look at is the supply and the borrow interest rate. So that pretty much would, so looking at that sort of replicates, looking at that sort of makes your funding rate very similar to like a perpetual option. And very much, when it comes to like, let's say, lending or borrowing, you just need to be cautious of those two. Now, some interesting things that you can think about when it comes to, let's say, setting up these types of positions is the fact that if you were to, let's say, lend a stablecoin, it's not possible, of course, for the stablecoin to drop in value. And so when you're effectively borrowing some other token against that, you're effectively shorting the token that you're essentially borrowing. When you think about, let's say, lending Ether but borrowing USDC, that is very similar to essentially having a long exposure to ETH, in which you'd like, of course, ETH in order to stay at that price or even rise in price, so that you're in a healthy position for that loan. And pretty much, that just allows you to have some that allows you to have some play money when it comes to borrowed USDC in order to then be able to trade or do whatever. And so very much another thing is that you can also look at, let's say, lending and borrowing different stable coins. What that allows you to do is potentially trade interest rates, so the supply and the borrow interest rate from those two, and pretty much look at seeing whether you can make a profit either from make a profit either from trading certain make a profit from lending certain stablecoins and then afterwards borrowing other stablecoins, or either, let's say, using the borrowed stablecoin in order to play and make some interest and money with. So pretty much just getting into the last chapter now. I guess any sort of questions about, let's say, money markets or just on-chain lending? Yep.
I'm not sure if you're about to cover it, but I was wondering if you incorporate any flash loans as well.
Oh yeah, I'm about to incorporate it. Yeah. Anyone else? Yeah, so pretty much, as the gentleman said over there, pretty much like some like the really, really cool things about DeFi is some of the things that you can't actually do in traditional finance. It's because of the fact that it's on chain. You can almost think of it as programmatic money that you can play with. And so some of the cool innovations when it comes to DeFi are some of the things I actually play a lot with in my job currently, in which it's quite easy to, let's say, borrow tens of millions of USDC in order to make a trade and then just pay it back in the same transaction. Or pretty much, let's say, try to lever up a certain position when it comes to a money market, let's say. I'll be speaking more so on some of these interesting different techniques when it comes to I was speaking more so on these different these pretty cool techniques more so that are a bit more relevant to, let's say, coding on the blockchain, I'd say. But I'll definitely, for anyone who is definitely interested in, let's say, more so on the protocol side, so your money markets or your instruments and whatnot, I definitely would suggest, coming forward the lecture to do with open on-chain options, in which they tap more so on the protocol side of things. So on to this last section, advanced DeFi concepts. So pretty much this case in which when it comes to, let's say, thinking about a trade that you'd like to make, you see that on a certain market, let's say ETH, BTC, that there's this exchange rate. But you also see that there are two exchange rates, ETH Litecoin LTC, which is 6.97, and BTC LTC, which is 3.66. Let's say you notice that there is some arbitrage in the market, in which you can, if you essentially trade this cycle, what can happen is that you actually come out with more of what you started with. And so that pretty much is the definition of an arbitrage, in which if you can essentially buy and afterwards then sell and essentially make a profit after that, from simply just rebalancing the market, then it's the case in which that's an arbitrage opportunity. And so pretty much it's the case in which that's pretty much you're essentially profiting off the mispricing of an asset from, let's say, 3 different markets. Now, the sort of things that can happen when it comes to, let's say, trying to make profit off that is the fact that, let's say, you try to make this first transaction, ETH BTC, right? But what happens is that the price of ETH LTC changes underneath you. So pretty much it now becomes, let's say it now becomes 6.5. And pretty much that in that situation, what can happen is that it can either reduce your profit or either cause it so that it will either slip enough whereby the arbitrage opportunity no longer exists. And because of the fact that you've already made this first leg of the trade, you've already bought some ether with your Bitcoin, you're now in the shitter. More so, you have to unwind your position to now essentially sell off your ether and then go backwards. And that involves a lot of different exchange costs that you might need to pay. You might need to pay commissions to your exchange or to your broker or whatnot. And so very much is a case in which, very much we sort of class these sort of types of risks where you essentially fucked up and you essentially have to unwind your position, essentially pay for not being able to execute your trades quickly. We call this execution risk. And so it's very much something that is very much looked at extensively in traditional finance, which most of that, because of the fact that there is execution risk, that people always have to add in a bit of a buffer when it comes to their price that they make for their limit order or market order, let's say. They need to be cautious more so of the price that they execute at, or that they might get a worse price because of the price slippage. Now, when it comes to think about execution on-chain, pretty much a lot of these, because of the fact that we have a smart contract that allows us in order to be able to do execution one after another sometimes. What we can do is that we can actually have transactions do multiple orders for us, in which what they can actually do is essentially bundle, let's say, this ETH BTC trade with this ETH LTC Litecoin trade, as well as this BTC LTC trade. And most of that provides us with atomicity when it comes to that trade, whereby what happens is that if I'm not able to make a profit off essentially trading these three markets, then it's the case in which the order never actually, those orders actually never execute. And very much I don't need to, generally is the case in which I generally don't need to pay a thing, actually. And so very much is, if it is the case in which, we do have, we pretty much are able to secure these prices, it's the case in which those three trades pretty much are executed. And very much is the case in which, we make our 26.84 Bitcoin in profit. And so that's a really cool thing that actually comes from working with smart contracts, is the fact that you're able to bundle multiple orders together in one single transaction, and afterwards be able to let it fail or let it succeed. And more so in that case is a case in which you can either make no money or you make a fuck ton of money. So pretty much that eliminates actually execution risk, which is one of the largest things that luckily saves a lot of headache for, let's say, traditional traders coming in from traditional clients into trading DeFi. They have a lot less worries that they need to think about when they can eliminate execution risk. Now, the gentleman earlier was speaking about flash loans, and more so one of the cool things about DeFi is the fact that you have flash loans. Now, let's go back to that example earlier of this triangle of trades that we have here. Now, you notice here is the fact that we need to start off with 1,000 BTC in order to actually initiate the trade. Now, we need 1,000 BTC, then afterwards to then buy, let's say, what is it, like 3,000 Ether, to then afterwards then buy 10,000 of Litecoin before then trading it back. Now, so this can cause a challenge, especially this can be quite a challenge, especially when it comes to, let's say, your solo traders, your traders that most don't have, let's say, 1,000 Bitcoin up in their wallet or in their trading account. And one of the cool things really about DeFi is the fact that you can actually take a flash loan from someone. So a flash loan is this concept of the fact that because you're executing your trades and your transactions atomically, that you can also then bundle in a potential loan in that. So very much is a case in which you can, let's say, in this example on the top left here, we can, let's say, if we notice that there's an arbitrage between two markets, right? That you can trade to the USDC DAI market on one, and that there's a different exchange rate on another exchange with a different different exchange rate for USDC DAI. Then it's possible in order to profit off that and maximize the profit from that, from essentially borrowing, let's say, any amount that you need, and then afterwards arbitraging the market's way. So in this case, we can flash loan 2.048 USDC, exchange it, and afterwards trade in the market in terms of swapping that over to 2.028 DAI. And then afterwards, then we can trade that, and then afterwards trade it for 2.064 USDC. And essentially we can see here is that we made a profit of 6.16K USDC. And so another thing with that is that pretty much allows us in order to be able to play around with a lot of money and be able to essentially allows us in order to be able to democratize a lot of different arbitrage opportunities. So let's say I notice, let's say, two different exchange rates on two different markets. If it's the case in which I notice that, there are those two different exchange rates, I don't need to worry about having the capital upfront in order to pay for that. what I can do is just essentially get a flash loan of, let's say, $10 million, and essentially use that in order to trade, trade away the arbitrage and the and essentially balance the markets, and essentially keep the profit for myself whilst I give back the original $10 million. And so that allows us, in order to essentially be able to, if you're a solo trader, be able to trade around with $0 in your bank account, and essentially just be able to spot these different arbitrage opportunities, focus more so on just making these different trading algorithms and scripts and whatnot. And once you spot an arbitrage and decide to execute on it, you can simply make the flash loan, whatever capital you need, arbitrage the market, keep the profit, and then there you go. Nice dinner at Burger and Lobster. So yeah, like a final slide. I know another piece that is like starting to get code, but hopefully, I'll just like run through this quickly. More so like MEV is like one of like the interesting things that I get to do with my job. More so, MEV is very much you can think of as high frequency trading on chain. So very much it's this concept in which once we look at this original order execution system that we had earlier in the slides, when it comes to this sort of a lunk of mess in which we have to think about a bribe that we associate with our order, very much is the case in which MEV is this really cool concept of seeing how you can profit from front running as well as back running trades. So you can think of this as, let's say, front running a transaction and copying what they're doing. If the transaction is going to be profitable and you, let's say, copy the same transaction and just essentially just jump the queue and front run them, then you can essentially steal their profit from them. If you notice that there is going to be a large market order that shifts the market quite a lot and essentially shifts the price quite a lot, but there's still some exchanges that are offering that are still quite slow in updating their prices, then it's the case in which what we can do is back run that transaction, back run that large market order, and also capture the arbitrage for ourselves. We can also, let's say, arbitrage liquidation events. So as I mentioned earlier, money markets, it's possible in order to, let's say, capture the arbitrage from that because of the fact that it has to sell the collateral to some exchange or money market, to some exchange or to someone. And very much what we can do is just back run that liquidation event and try to profit from ourselves. Sandwich attacks are very much like what you can think of as front running and back running. Now, pretty much is a case in which a lot of these different things, of course, like as the name suggests, in maximum extractable value, can sound quite toxic in nature. You're pretty much like, pretty much why a lot of like, let's say, physicists might hate people, might hate especially computer scientists, is the fact that a computer scientist going into finance is the fact that you're pretty much like not helping the world in terms of doing something good. You're pretty much just making money and just trying to essentially make a lot of it. And so all of these different things can seem quite toxic in nature, but there's been some research into this concept of MEV and especially this priority order execution system, since it's quite new, especially to the finance world. I'm also looking at different ways of trying to either reduce MEV, so trying to reduce these different opportunities in order to arbitrage different transactions. So more so, one good example is, let's say, making the mempool, making this pool of pending transactions private through the use of, let's say, flashbots. Another example is payment for order flow systems that we're now sort of seeing come up in the market, where if you would like to back run a user's transaction, you have to pay them a bit of the profits in order to essentially back run them. And a lot of like different looks into different designs in order to reduce MEV and whatnot, and especially looking at how MEV, how this is activity that happens on chain, not just for the Ethereum blockchain, but also for other different blockchains, such as the Cosmos ecosystem, let's say, or Solana, and pretty much trying to quantify all of that. And now, yeah, some further reading is a case in which, yeah, I'm not sure whether it might be helpful for some of you, but if you're ever interested, yeah, Imran will happy to get a copy of the slides and send it around. More so, yeah, some additional resources that you might want to look into. Let's say, so Carbon is a good example of, let's say, a market maker that essentially just sells unidirectional limit orders. So let's say if you just want to sell, let's say some ether and just sell, but at specific prices, then you can automate it with, let's say, a protocol like Carbon. The gentleman earlier mentioned about flash loans and how it's possible in order to essentially level up with certain loans and whatnot. And so very much is possible in order to use flash loans in order to set ourselves up with a, let's say, a large lend borrow position on let's say RV. And so there's a lot of different strategies that sort of look at that. More so one of the biggest ones might be the degen box strategy that some of you guys might have looked at, but most of that is something to look at if you're thinking about the different ways in which you can essentially profit and essentially trade money markets. Replicating market makers or virtual AMMs is something that I'm not sure whether the guys are open to cover, but yeah, I've just left it there just in case. It was a very interesting concept in which you not only in which AMMs not just only can be used for, let's say, spot markets for, let's say, buying ETH or selling Bitcoin, but you can also use it in order to replicate the payoffs of different financial instruments like perpetuals, futures, and interest rate swaps even. And another interesting area that you might want to also look at is impermanent loss hedging. So I didn't speak too much about this, but yeah, I didn't speak about this at all really. But yeah, looking at how you can essentially hedge your position, hedge your inventory, especially when you make these trades using options as well as this instrument called Squeef or Squared ETH, which yeah, the open guys will speak about. I've also yeah, listed a couple of interesting things that if you guys, yeah, if any of you guys are interested in looking more so on the blockchain side of things, so especially on, let's say, the trading, if you want to be a trading engineer for cryptocurrencies and whatnot, these are interesting concepts you need to look at. So potentially doing this is an example of so Olympus rebase hopping is a example of a, let's say, MEV strategy, in which you trade around a index rebalancing or a rebase essentially. And so very much you can look at how you can, so I've listed some links for that, and you can see how you can exactly, let's say, front run and back run a transaction. You can also look at bundles, and then also there's block level flash loans that you can also look at. But yeah, that's pretty much it and whatnot. And yeah, thanks. Yeah.